The big beautiful bill earlier this year gave us 6 major changes that affect our year-end tax strategies. So we want to go over a 10-point checklist to look through to save as much in taxes as we can between now and the end of the year, and how these 6 changes affect that. But before we get into that, my name's Joe Franklin, and here at the Mustard Seed, we're all about putting faith with finance, and we care more about what the Word says than just about anything else. Today, we're going to go over these new things in the tax code. They're pretty black and white, but there's ways to massage things to save a lot of taxes between now and the end of the year. So let's get right into that. If you're over 65, you have the new senior deduction. That's $6,000 per person. Now, if you make over $150,000, you don't get the full benefit of this. And if you're doing Roth conversions, it could push you above that $150,000 mark. So we want to pay close attention to how much we've been doing as far as Roth conversions. The optimal amount to be converting is likely down if you're over 65. Especially if you're looking at also starting up your Social Security. So the very best time to be looking at Roth conversions is after you're retired and before you start taking Social Security and before you're impacted by the senior deductions. Now, this is only good for until 2028. And also we want to try to do as much as we can before we hit the RMD phase. When we're forced to take out, we want to do the Roth conversions when we have more flexibility. The end of the year is a great time to be looking at whether we want to do Roth conversions or not. If we're doing Roth conversions, unfortunately, they do not let us do these do-overs or recharacterizations where if you converted too much or not enough or what have you, you can go back and do it over again. So we want to wait until the market sells off to do Roth conversions, or when we have a year where we're not making as much. Pay really good attention to how much we're doing each year so it doesn't impact us too badly. With RMDs, we want to make sure that we do these before the end of the year. If we don't do enough, we have to pay a nasty penalty, but we can get around some of these RMDs and save. One thing that we can do with RMDs is we can take the entire amount of the RMD and give it to charity if we want to. We can give part or all of it to charity. We don't have to pay any taxes on that required minimum distribution if it goes directly to the charity. You can give over and above your RMD as well. You can give up to $100,000 in a given year, and when you're taking it out of your IRA, you don't have to pay any taxes on it. And so let's say we got a guy named Louis, and Louis is having to take required minimum distributions out of his IRA to the tune of $15,000. He doesn't like to have to pay taxes on all that, and he doesn't want all of it. He just wants to give a lot of it to charity. So he gives $10,000 to charity as a qualified charitable distribution. Louis' remaining required minimum distribution of $5,000 will count toward his taxable income, but the rest is not going to be taxed. Now, Louis can also take the entire amount of his required minimum distribution as a qualified charitable distribution. He takes $15,000, he gives the full $15,000 as a qualified charitable distribution. He satisfied his full required minimum distribution by giving it all to charity or the church or what have you, and his income is zero from this, and he doesn't have to pay any taxes. If you're over 70 and a half, you're not even subject to required minimum distributions yet. You can give up to $100,000 to church or charity and not be taxed on it. So that's what a lot of people like to do to get their IRA balances down to a more reasonable place by giving to charity and not having to pay near as much in taxes over time. Now, you want to make sure that you're not going to be impacting your retirement, but you cannot give more than $100,000 in any given year. So if you're really charitably inclined, only $100,000 of that is going to be tax-free. One thing to keep in mind about required minimum distributions is that with 401ks and 403b plans, you have to go into each individual plan and take out the amount that they say you have to. You can't combine them together. But with IRAs, you can combine these all together. And with Roth IRAs, you don't have to take RMDs at all. So a lot of people like to put as much as they can into Roth so they don't have to do these RMDs. But with the IRAs, because you can combine them all together, you can look at what you've taken out of ABC IRA, IRA at XYZ company. And when you look at this, a lot of times people have turned on income that's above the RMD amount in these annuities, they don't have to take out near as much out of the other IRAs, and in some cases they don't have to take out any out of the other IRAs. And a lot of people don't figure this into the equation, and they end up taking out more than they have to. So it's important to make sure that you don't take out more than you have to, because then you'll have to pay more tax. A lot of people have got a lot of capital gains exposure from the past 2 years and this year. A lot of people made a lot of money, and because of that, this capital gains exposure may cause our taxes to be really, really high. And so we may want to consider reducing the amount we're taking as far as Roth conversions are concerned. We want to look at these unrealized losses in the portfolio so we can do the tax loss harvesting. But if we are able to not do as much as we want to, then we want to look at reducing the amount that we're doing in Roth conversions. We may have planned to do more, but because of the senior deduction, the high capital gains, and everything else, then we may not want to be doing as much in Roth conversions this year, and maybe for a little bit because of the senior deductions. And this year's been a really good year for a lot of people, so the net gains may be really high. When you combine 2023 with 2024 and 2025, and maybe you took some gains on those 3 years, all in 2025, you might have a lot of gains. And if you do, you've got to look through the portfolio and see how you might be able to offset the gains with losses or other things that you can look to. To help mitigate some of this, look at what you have in the portfolio that has a loss on it. You may want to still own it, so we want to talk about how we can still own it and still take the loss. But if you take this loss before the end of the year, then you can work this loss against the gains and you don't have to pay near as much in taxes. A recent study shows that you can save a lot on your taxes by utilizing a tax harvesting strategy. This study shows that if you're in an aggressively positioned portfolio in a normal year, you can save around 1.42% on your taxes if you're in an equivalent of a 25% tax bracket. Now, if we look at a higher tax bracket like 35% and you're aggressive, then that's more like just shy of 2% per year that you can save on your taxes on average. But if it's in a down year or a really bad year, they're saying that it's over 4% that you can save, offsetting the gains with losses in your portfolio. And what we can do is, by utilizing the opportunity zones, we can defer to a bad year and take advantage of this in a bad year against more gains, because we can time when we're taking our gains much more effectively by deferring these with opportunity zones. So what a lot of people do is double up on the things that we want to still own that are down, so we can take a loss on it after 31 days and continue to own the things that we see as a good value that we still want to have in the portfolio, but go ahead and take that loss and maybe make a little bit more by buying more at a low price. We can sell things in the portfolio that are down and replace them with other things that are similar. Let's say we're selling Exxon at a big loss one year. Exxon is correlated about 93% with the index. So when Exxon goes down, so does the index. When Exxon goes up, so does the index. Now, it may be that Exxon does better over time because it's a better run company. But in a short-term scenario, let's say you sold Exxon and you bought the index, you held on to the index for 31 days, you sold the index and then bought Exxon, you can take the loss on the Exxon, buy it right back, and never miss out on a whole lot. If we've got big gains in the portfolio and there's not a lot that we can find to sell, then we can use what are called opportunity zones in the portfolio. A lot of people are familiar with doing like exchanges with property. These are called 1031 exchanges with real estate. The opportunity zones are very similar to doing 1031 exchanges with property, except you can do the exchanges with anything for the opportunity zone property. And you can buy opportunity zone funds and you can buy opportunity zone ETFs. What you do is within 6 months, identify what you sold and what the gains were. You only have to buy an amount of opportunity zone that equals the gains. And as long as you hold on to those opportunity zones, you don't have to pay any taxes on those gains until you sell the opportunity zones. So if you hold it for a week and hold it from 2025 until 2026, you're basically just deferring the taxes from 2025 to 2026. You can hold it for a much longer period, and when you do that, the government gives you extra benefits in taking additional amounts off of your taxes. You can save 10 or 20% in addition on your taxes if you hold these opportunity zones for a longer period of time. We found that the opportunity zone investments historically have not done quite as well as owning stocks, so we don't want to necessarily defer for too long, but they can be a great way to defer taxes. And they made these opportunity zones permanent in the latest One Big Beautiful Bill. Now, if you know you've got this appreciated stock, you're going to give the money away to church and charity anyway. You can give the money to your church or give it to a charity. And when you give it to them, you don't have to pay taxes on it because you're giving it away. And they don't have to pay taxes on it because they don't have to pay taxes, period. So by giving the appreciated stock, it benefits the charity. It also saves you a lot of taxes. We don't want to own mutual funds outside of retirement plans, but if we do, we want to be checking to see what the capital gains are going to be before the end of the year. Typically here at the end of November, they announce what the capital gains are going to be, and they're going to pay out in December. It doesn't matter how long you've owned these mutual funds, you have to pay the taxes whether you've made any money or not. So you have to pay taxes on the money that somebody else made, and that's no fun. So let's make sure that we don't own these things outside of IRAs and 401k plans. With an ETF, the tax structure is a lot better than with mutual funds. And if you own these mutual funds, when you look at what the taxes are going to be, you might keep some of the ones where you've got big gains, but you don't have to pay taxes on the gains right away. But if you have to pay a lot of taxes on these, and you can see that you have to pay a lot of taxes on them, you might want to go ahead and sell them so you don't have to pay the taxes on gains that you maybe didn't make. Make sure you've contributed all you can to the 401k plans, to the profit sharing plans, and make sure your spouse has also. Now, if you're a business owner, what you may want to consider doing is contributing the max for you and then also contributing the max for your spouse. If your spouse doesn't work, you can still show him or her as an employee and just contribute a little extra into Social Security and what have you and get the max into the 401k. And you get the bulk of that working for you, and you get the tax deduction to save you this year. You can also pay your kids. If they're under 18 years of age, you don't have to pay into Social Security for them. And your kids are going to be in a really low tax bracket also. What we also want to look at is the health savings accounts. If you're over 55, you can put in about $9,500 for a family, and that's money that's never ever taxed. It's not taxed when you put it in, it's not taxed as it grows, and it's not taxed when you take it out if it's used for health purposes. So since it's never ever taxed, it's the very best place to save of any place that we know of that you can save. So take full advantage of those health savings accounts. Also, if you got flexible spending accounts, make sure you use it before the year is up, because with those, if you don't use it, you lose it. With the health savings accounts, you get to keep the money growing. So those are great. You want to keep those growing as much as you can because that's tax-free. It's a great asset to keep growing for you, and use it only when you really, really need it. If you let it grow tax-free, it's going to grow more than just about anything else. This year, we also have bonus depreciation. We can buy equipment and depreciate 100% in the first year. We have accelerated depreciation on new buildings. If it's for manufacturing, you can depreciate 100% in the first year for that as well. One other new thing that came about through the One Big Beautiful Bill was a $1,000 charitable deduction that everyone can use, whether you're itemizing or you're just taking the standard deduction. So we know that the new standard deduction is now $31,500. If you're over 65, you get this extra $6,000 per person, so it's $12,000 for a couple. And then you have a charitable deduction that you can use on top of that. That's $2,000 for a couple, or $1,000 per person. When you add that all together, that's over $48,000 that you can take off. That's all deductible. So if we're in a lower tax bracket, and let's say all of our income is coming from Social Security, we can receive, let's say, $45,000 in Social Security, and the 12% bracket ends around 96,000. And around that area is where capital gains tax is also zero. If you're in this lower income area, let's say you've retired, you're not drawing anything out of your IRAs, you can actually receive capital gains up to around $96,000 because your Social Security is all being utilized against the deduction. So it's huge if you're over 65. You can take a lot of capital gains, pay zero taxes on those capital gains, also pay zero taxes on the Social Security, and then you don't have to worry about having to take the gains in future years and worry about the taxes on that. So if you like this video, we encourage you to look at this video here, hype the video, subscribe, put those thumbs up, and we'll catch up with you next time.